National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice. And today, what every producer should know about taxes with special guest Ken Davis, CPA. And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant.
Well, welcome everyone to the Business Insurance Zone. We're broadcasting live to a nationwide audience of financial professionals right here in Fountain Hills, Arizona, home of America's largest fountain, although I notice when I look in the background, it's off right now at this time. And of course, with me, special guest again. People are asking, is Ken my co-host forever? Well, we can't let him do it forever because we're not that anal retentive on the tax code. However, we are talking about taxes all this week, and the reason we're bringing it up again is because we want you to see the power of how our products play and integrate with the code and actually will give your clients more net spendable income.
Right.
And that's what we're talking about. Now, listen, we left yesterday's show. I was kind of, how can I say this on the Insurance Zone? I was not happy, let's just say that, on the sunset rule of the alternative minimum tax, because it's one thing when they created this tax, if I understood I loved Ken's historical anthology. I felt like I was on the History Channel yesterday. You know, when I was listening to you, I'm like, okay, I understand they did the AMT because they had professional fiduciaries milking the benefits of the code. I see that, and they wanted to make sure you paid something, at least minimum, right? I kind of get that. But what I don't get is they let the sunset provisions go off into the sunset, and then all of a sudden the AMT is way down here in lower.
The exemption is lower.
Yeah, the exemption is lower middle class, right?
Right.
I don't get that.
Well, and the idea was for the exemption is this is only for the quote-unquote rich people, and so we'll put this exemption that's really quite high so that only the truly rich will start getting hit. And to just remind our viewers, we have our regular tax rates and then we have alternative minimum tax, and they're two separate calculations.
Well, before you go on, though, Ken, you just spurred a question here. So when I'm hearing the top marginal bracket is, what, 35% or whatever it is? All right, the top bracket is 35. That does not include the additional AMT tax on that.
Well, yeah, it's one or the other. It's not in addition to.
Okay, it's not in addition. Okay, just making sure that's clear.
Okay.
Thank you. That even I learned things on the business insurance.
Well, we ended yesterday talking about the fact that the exemption amount dropped from $74,450 on December 31st, 2011 to now $45,000. It's almost a $30,000 drop.
I know.
And 74 wasn't all that high in the first place. I mean, are people making 74 grand a year of taxable income rich people? No. You know, that we keep hearing on the news that they're going to go after the rich people. Well, here's a situation that they started with the quote-unquote rich people, and they were pretty high back when it first started many, many years ago, but it wasn't inflation adjusted. So Congress at different points along the way would increase the exemption, and unfortunately, because all this political jockeying in an election year, they keep changing it. Well, it was 74, now it's 45. And here's the other thing too, the exemption ultimately goes away for those that really are making some pretty substantial money. For instance, last year, the exemptions went away if the alternative minimum taxable income was over $447,000 for married and $223,000 for married separately and $306,000 for individual. Well, now that $447,000 dropped to $330,000 is when they phase that all together. So I don't know, this whole idea of taxing the rich, it doesn't look like you have to be so rich to have alternative minimum tax. There's going to be a whole lot of people waking up to.
Well, you're telling me 45 grand? I mean, if I'm saying at 45 grand, how can I possibly be paying the AMT? But in 2012, you might be.
Right. So you're going to have a different tax. And in the packet that's available for free when they send in, we have like 3 pages on this. There's actually a form shows how it's computed and then talks about the adjustments and tax preference items to come to that.
Just a little heads up here, Ken, before we leave AMT land. I have to say that some of the product, not all municipal bonds, as an example, are subject to the AMT, but some are.
Well, that's interesting, and a lot of people think municipal bonds are tax free.
Right.
Well, the fact of the matter is that certain kinds of municipal bonds create tax preference item, which gets added back in for this calculation, and then there's also people that invest in oil.
Yeah, there's depletion
allowance type
yeah.
things, accelerated depreciation.
Right, and I guess,
but the one that's most common is your itemized deductions. Mm-hmm. It's not actually. It's an adjustment as opposed to a tax preference item. You actually add those deductions back in to come up with this new taxable income. So,
well, I'm still back at the muni bond thing, because I think most of the people that I know that are buying and have a good size of their portfolio in municipals they did it for one reason. They didn't want to pay tax, and some, not all municipal bonds. Some are subject to it, and not only that, but the tax-free issue of the municipal bond being subject to the AMT, and that it might cause your Social Security to get taxed.
Well,
I don't get
we're
that.
going to talk about that later, but that's really more insidious, is that all municipal bond income is added back in to determine whether or not your Social Security is taxable. So let's not go too detailed on that, because we're going to bring that up later.
Well, let's talk about managing, because we gave some definitions yesterday. If you missed our show, you need to hop back out, www.brokersalliance.com. As soon as you come, you'll see the red button for our on-demand section. Go ahead and click it and catch Monday's show, all about taxes. Everything a producer should know about taxes, so that you can see the value of what we're selling, because we really have some advantages.
Right, and really what we're selling, if you look at our products, annuities and life insurance primarily, are tax deferral devices. They're not tax deductible devices in most cases, although the Section 79 show that we did last week talks about how you can get a partial deduction in a business setting for life insurance. However, all the earnings inside of an annuity, all the earnings that build up inside of a life policy are not taxable, meaning there is no 1099 form that you receive at the end of the year. Well, why that's important is reportable income comes in as gross income, then filters down to adjusted gross income, and that AGI, as we're learning, affects all kinds of things: AMT, Social Security, exemptions, credits, deductions. AGI is looked to all over the place. And Steve, this is I was shocked. It had actually been out a while, and I wasn't aware of it. It's not a tax law thing, but Medicare premiums for our elderly, our retired that work their whole life, they're getting nailed if their AGI is above certain levels. They now have to pay more for their Medicare benefits. And that's not a tax law. That's using a tax law concept to determine what their rates are going to be on their insurance.
I mean, well, so like back to your other example, the EMT. I mean, I feel like this gal, she hits 45,000, she has to pay that additional AMT tax, and now that might mess with her Medicare.
Yeah.
So she gets it twice.
Well, and get this.
Unbelievable.
We want to consider ourselves a compassionate nation. And what happens when a couple that have been married for 50 years and the husband dies off, because unfortunately we guys pass before the ladies.
That's actual real science. Right there.
And she was okay with they're okay under the limits, and suddenly they go from two people to one person, and the AGI limits on the Medicare are based on a single person, not a married person. And she may now be over the threshold. So she just lost her husband. She's grieving. Okay, and now she's subjected to single rates and higher Medicare, and then Social Security may be taxable. I mean, suddenly all these different rules change radically overnight for this poor woman, and she's subjected to these higher premiums and higher taxes and everything else. And gosh, she might be 75, 80, 85, 90 years old, and suddenly all this is happening to them. And it's just, I don't know, it's a shame. It's just.
It is. I mean, you lose your spouse. That's a bad thing as it is, especially 30, 40, 50 years, some of these couples. But on top of it, just about the next year when you're doing your filing, you're sitting there going, the next year I'm going to be owing a lot more money than I used to.
Well, and think about it. Pensions, when people retire, what do? They choose full benefits only for themselves, benefits for them 100% and the wife, and of course that reduces how much they get, and they might be tempted to cut it back to 75 or 50% if they have those options. So suddenly their income drops by half on the pension if they still have it, and all these taxes and Medicare thing pops in. So reduced income, increased costs and taxes. It's nasty. It's just, I hadn't realized this until I started researching this whole taxation Social Security, and I start thinking, oh my gosh, the tax code really doesn't like our retired folks.
No. Well, I have to say, managing AGI is such an excellent, this is a tutorial that we do really need to pick up on and really understand basics. And again, I had this in our first show. I'm going to just show it again. We have this great form by AXA. It's a 1040 overlay. It's got a nice little kind of a plastic veneer you can put on this, and it's really nice. It really does the job for you, and I really recommend it. We'll give it to you. Just write me, thebiz@brokersalliance.com. I'll send this to you, and I'll keep sending it until AXA tells me we don't have any more to send out.
And just so our viewers know what we're talking about, it's basically a transparency that you just lay right onto the Form 1040, and it points out and annotates with the overlay each of the items on the tax return that you can learn. For instance, it could be, how many dependents do they have? Okay, so if they have dependents, then they may need life insurance. Okay, and so there's all kinds of things that pop out when you do this, and they have a guide that helps you evaluate and analyze the tax return from a sales presentation as to what you can do to benefit the client.
Well, if I'm hearing everything we're talking about today, the end game of management is the end game of reducing it. Right. I mean, that's the end game.
Well, and the fact that we can have earnings built up tax deferred. And let me make this point. We had our year-end tax planning thing, which is how do you get deductions, how do you do things at the very last minute to get some tax benefit. Well, now we're talking about tax deferral. Can't affect tax deferral or income at the end of the year, but I can at the beginning of the year. And that's why we're talking about this now, is if you take money in taxable bonds or even municipal bonds that affect adjusted gross income, and we put it into annuities or life insurance, if they're appropriate products, then there's no earnings on those, and so we reduce our gross income. So we go from a taxable product to a non or a tax deferred product, maybe tax free ultimately with life insurance, and we affect that, which affects adjusted gross income. So not only did we reduce our income, we may have dropped into a lower tax bracket. We have a smaller adjusted gross income, which may reduce the amount of taxation on Social Security, may increase the deductibility of other deductions, credits, exemptions, may have an impact on alternative minimum tax. All of these things are these moving targets, and these AGI limits aren't consistent. They're different for each part of the code, and so the only way to really do this is to work with a tax advisor or somebody that's conversant in this and run it through a tax software program to see what the actual impact is of making these choices.
And I think this tutorial, it wasn't really meant to be educational, but this 1040 transparency is a great, not only sales tool, but a great educational piece. And if you want this, again, just call me at 1-800-290-7226, extension 147. We'll send it out as long as AXA keeps giving it to us free. We'll give it to you free. And when we come back, I want to touch on Lincoln Benefits 2012 tax summary, just to make sure everybody has a heads up that they have access to that. You're listening to the Business Insurance Zone, the talk show that talks about insurance in your practice. You can write us at thebiz@brokersalliance.com or call us toll free 1-800-290-7226, extension 147. Right after the commercial, Ken and I will be right back after a word from our sponsor and premier provider, Brokers Alliance.
Whether you're a professional planner pursuing a strategic partner or an insurance distributor seeking a national alliance, your business just went into overdrive. Now enter the largest resource of insurance products and services with unparalleled access to a worldwide audience of consumers through the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, who can take your company and launch it into the stratosphere of success. With countermeasures, the most comprehensive carrier intel in the industry, the MASH unit with field triage underwriting and the premium tolerance test, the life insurance financial evaluation, the most rigorous policy review, and Bravo high-definition broadcasting with online social media. Your search just ended.
Well, welcome back to the Business Insurance Zone. I'm Steve Savant, your host, insurance columnist, financial color commentator, and I think interviewer extraordinaire. Remember, before moving forward with anything that we talk about, especially this week's show, touch with your CPA, your tax attorney, and your broker-dealer compliance department. You can call me toll-free, 1-800-290-7226, extension 147, for any of your quotes or questions on life insurance, annuities, DI, LTC, and group pension plans. Hey, it's not what I know, it's who I know, and that's why I have Ken Davis, CLU, ChFC, CFP, and CPA on our show. Ken, we were talking about, just before we went to the break, about all the impact of managing your AGI.
Right.
And I really want to manage it because I don't want to be caught in the back door with the AMT. I don't want to be sitting there paying taxes when I don't have to pay them.
Right.
And part of that is knowing your 1040, and that's why we're giving away that AXA 1040, that transparency. It's an educational tool. It's a great opener for sales and marketing. I mean, we've been using it now. It's really great. And I just want to encourage all our producers, if you just learn a few of these things. And the last thing I want to talk about is, just before I went to the break, is Lincoln Benefits summarized the code. They've been doing this for years, and it's been on their website. We have a little up front. We got this right away, so it's out there. And I just want you to be able to think about this. It really is a digest, a quick 2 pages digest. I would laminate it and keep it with you everywhere. And when I was looking at this, and Ken taught on this yesterday on our show, a little bit about marginal brackets, and now we're talking about things that we're going to get into, like tomorrow, product issues, annuities of life. The next time we're going to be talking about qualified plans, IRAs, all these things that can impact your 1040 in a big way. Ken, when we're talking about getting a summary sheet like this, and I mean, this is kind of next to this 1040 that we're giving away from AXA, Lincoln Benefits tax summary sheet is excellent because it really gives us an idea of what we're actually paying. And when I'm looking at this, you were talking about this thing at the break. It blows my mind. You have a person that's been married for all those years. They've been getting a certain amount of income. I mean, pension could have went down in half, right, if they didn't elect it.
Right.
Isn't it true that Social Security, the survivorship benefit's less?
Right.
Yeah, I mean, there's a lot of impact here. So it's not only the loss of a spouse and the grief of it, but it's the economic Armageddon that can occur. And I mean, think about this. You could be sitting there. I just did my projections, and if you're a baby boomer at my age, I just looked at, hey, should I try to collect at 66 or should I try to go 70? What's my benefit? What's my spouse's benefit, right?
Right.
I mean, I started looking at that hardcore. Whoa, you know?
Well, let's talk about that real quick. Let's say that you've got a married couple and they're in their 80s and the husband passes away and they were making $70,000 in taxable income.
Mm-hmm.
Well, that's a marginal income tax bracket of 15%, right? Well, suddenly, let's say that she didn't have a reduction in her income from Social Security and other things, and somehow she still retains that 70. She's now in a 25% bracket for anything over 35. Or just say she drops from 70 down to 50.
Mm-hmm.
Well, instead of 15%, now the excess over 35 of that 50 is now at 25%. She just had an increase in marginal income tax bracket of 10%,
Mm-hmm.
plus increase in Medicare premiums,
Exactly. 'cause
plus
that's all
potential
affected.
taxation, Social Security, limits on deductions and credits and all this other stuff, and even the alternative minimum tax we talked about earlier. Now her exemption drops as well. So I mean, what does that drop from? It drops from $45,000 for married filing jointly to $33,000. So she's grieving for her husband. She's got all this reduced income and higher taxes. It's nasty. It's just not good.
Well, we're talking about a lot of the planning we do is retirement, and we do estate planning, of course.
Right.
But a lot of it's income planning and retirement
Right.
planning, and that's why we're talking about it all this week. And one of the key issues is, we're trying to help our people get prepared for their golden years.
Right.
And now it's kind of tainted, and I think I don't mean to be funny here, but I think it's kind of yellow on the part of the politicians that they don't really square with the seniors. This is the real number. You're taking it in the shorts in Medicare, right? I mean, because everything's going to go up. So you're subject to all these. We're just talking about 10% bracket. Then I got the Medicare issue. I have so many things. My Social Security may be going to get taxed. When I see a spouse die, the next year's impact statements are going to be brutal. Most seniors are living pretty close to the edge.
Right.
And now the government's going to take more for mom, who generally, from a death point of view, is going to survive her husband. Now we're looking at numbers that are just they're punitive, Ken.
So what it all comes back to is tax deferral. That's the phrase. That's what our agents can do with annuities and life insurance, is the earnings inside of these products are tax deferred. So when you look at their planning, if there's assets that they don't need at this point in time current income off of, and they can take it out of bonds, certificates of deposit, even municipal bonds, because that impacts Social Security and some other things, the deductibility or taxability, and can move it into one of our products, then they're not going to get 1099s at the end of the year, and so we're going to lower potentially the adjusted gross income because we don't have gross income from their earnings, so then the AGI drops, and that impacts their tax brackets, credits, exemptions, deductions. So we can have a multiple level of deduction. I'll give you a real example. I had a woman who was divorced, and she was elderly, and the attorney wanted to put it into CDs and municipal bonds. And this was many years ago. And this was my first huge client when I was in my 30s. This lady brought in $1.5 million, and it was a referral from a CPA. The reason the CPA, he pitted me against a couple other people for this case. And I said, gee, why is she buying the CDs? For safety and liquidity? He says, yeah. And I said, well, how much income does she need? Well, it turns out the municipal bond portion would pay her more than enough money to live on. So the earnings off the CDs really weren't necessary to live on. So I said, why don't we put it inside of a variable annuity with a U.S. government bond fund in it, so she gets the safety of the back in the U.S. government and no current taxation. Well, the amount of taxes she saved, I forget what it was like $15,000, $20,000. And so it was just using the tax law to rework the thing and say that to the CPA that I got the referral from the CPA because I managed this issue of taxation. So can it be powerful? You bet.
Well, yeah, I mean, because of the CD's getting ordinary income tax, whether she takes constructive receipt of it or not.
I mean, this was my first really large client. It was one of the most exciting days of my career when that happened.
And really, we're going to do a whole show. We have to do this. Ken's got a whole tactical issue on the use of annuities in combination with different times, different types of annuities.
Right.
That can be huge in the laddering effect, and they have direct impact on taxation. That's the big thing.
Well, in fact, you and I have discussed putting on a show just talking about the use of immediate annuities and regular deferred annuities in combination so that we can create an income that is mostly return of capital, so there's no gross income and it doesn't affect AGI, and let the rest of it grow either in annuities or life insurance for later use.
Yeah, there's so many tactics for us as producers to really ratchet down the taxable event because of the AGI. We can really get those numbers down using deferral products. And the second thing is just to know a little bit. We're not asking you to become a scholar. We're asking you to know a little bit, up your game a little bit. We're giving away, again, the AXA 1040, transparency layover, excellent tool. And the second one is the summary sheet of the 2012 taxable event issues.
Well, and I'd like to segue real quickly while we're talking about that is, remember, this is deferral. We don't get deferral at the end of the year. We have to start planning and doing that now. So get these assets. This is, you can create a timeline or some urgency with clients saying, hey, we did year-end tax planning. We're past the fire drill. Now we have kind of a new fire drill. We need to go out and start doing some planning so that you don't have a big 1099.
Well, let's talk about this because I think this is where our producer audience who's watching this, our financial advisors, we waited to the last day. We did the end of the year. We did it, right, Ken?
Right,
and we gave all these things. People were scrambling.
Yeah,
I mean,
yeah.
They were hitting us for information. By the way, happy to do it. And we were kind of ready because I've been in this thing almost 30 years. I knew we'd wait. We're coming to say, this is the time to get in front of your clients now, where you can position them and start to do planning, income planning, retirement planning that'll have an impact at the end of the year, and you won't be in a rush like we were.
Well, and here's the other thing that you can do a pivot on when you start talking about your clients about making their IRA contributions for the prior year. Currently, you know, they're thinking about taxes as we approach April 15th. This is on their mind. The vacations are over, the holidays are over. They're now paying attention to gathering information and stuff. And so it's on their mind. It's a good time that when they talk about IRAs and other things, say, hey, while we're talking about that, we need to do some planning now so that you don't have a big problem at the end of the year. So as long as we're looking at numbers, let's look at what we can do to reduce your taxation at year end, and that is using the tax deferral. This is in the kit that they can call in for or write in by email. This is a sheet that says, does it matter when you contribute to an IRA? And it's all about the concept of contributing your maximum contribution to your IRA today, not at December 31st or even April of next year. and it says, let's say somebody's 45, and they religiously at the beginning of the year put their contribution, their $5,000 contribution, they make 5%. At the end of 20 years, they'll have an extra $8,000 in accumulation simply because they started at the beginning of the year instead of the end. If they made an 8% return, then that's $18,000. Now, we have young kids, and if we can get them to put that $5,000 away, gosh, the time value of money, look at this. A 25-year-old putting it in for 40 years to 65 at 5% would have an extra $30,000. And at 8% would have an extra $103,000 because of this time value of money concept. So simply by doing your contribution today, you can make a major impact. Well, then you multiply with husband and wife, you double those numbers for 2 IRAs, right? They do their 401ks. There's even more. If they start putting in annuities and life insurance and all that stuff, they're going to have that much more. And if it's life insurance and they put it in there for 30 years, it's stunning.
I mean, there's the catch-up provision, all that stuff. We're going to be talking about all that tomorrow. IRAs, qualified monies, and the catch-up provision, which I love, is it's not a condiment. It's the way to catch up if you're a geriatric. I mean, think about that. I mean, people go, what's the catch-up provision? Well, I keep forgetting, not everybody that show is just a producer. Sometimes we actually get retail clients. Hey, you can watch this show and all our shows this week in beautiful HD 1080p right on our home site at www.brokersalliance.com. Just hit the red button on demand section. I'll put you right in there. And of course, all of our social networks like YouTube, Vimeo, LinkedIn, Facebook, and of course where I tweet on Twitter. I'm Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone. Get in the insurance zone.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. The Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.